Hello, welcome to this video on the discounted cash flow model. The discounted cash flow model is a very common way of valuing a business or valuing any sort of... The DCF models that we hear about are commonly used in industry, and it's probably the most used valuation method. So how do you use a discounted cash flow model? Well, a discounted cash flow model values a firm's assets, and it's equal to the free cash flow forecast for future periods, present value. So divided through by 1 plus the cost of firm capital to the power of t for each year. We then have a terminal value assumption at the end, and that gets present valued back as well. So the setup of this model is similar to a dividend discount model. Okay, for a dividend discount model, free cash flows would be dividends. However, the free cash flows of the firm are generated by the assets of the firm. So we're valuing the overall firm's assets, which means we use the cost of capital for the firm as well. If you want to value the equity, you have to remember at the end, after applying this model, minus off the firm's net financial obligations or their debt to make sure we get the value of it. So the steps in implementing the discounted cash flow model: you forecast your free cash flows. For us, we'd get that from our forecast template. You estimate the cost of capital for the firm. I'll talk about how you can use the weighted average cost of capital in a future topic. We can then calculate the forecast free cash flow growth patterns. So we've got our forecast free cash flows for maybe 5 years into the future. Then we think about if those patterns are going to continue growing or shrinking, or if free cash flow will stay the same. And then we use those growth patterns to come up with a terminal value assumption. Do you think free cash flow will go to zero? Will it stay what it was in year 5? Will it grow into the future forever? What sort of growth do you imagine will happen in the terminal value? Okay, so you can then use that to calculate your terminal value. You then discount each of the free cash flows and the terminal value by 1 plus the cost of firm capital to the power of t to get the present value. You add them all up and you've got the firm's total value. If you want to value the equity to come up with a share price, you then minus the firm's debt or their NFO. So the free cash flow model is a pretty simple valuation model that we can use. However, there are some disadvantages to using it. There are some companies which it doesn't apply as well as other valuation models, or there's some disadvantages in using it. So this is some old data from a very large successful company, Walmart. This is Walmart's financial performance from the late 1980s and early 1990s. And if you look at the Walmart cash flows, for most of this period, they have significant negative free cash flows. In the early 90s, Walmart were growing really, really rapidly. Their cash investments were significantly higher than their cash from operations. So they had negative free cash flow. If you were valuing Walmart, for example, in 1992, and you knew they were continually building new stores and investing in growing their business, you would be forecasting large negative free cash flows for the next few years. Using a free cash flow model, this would indicate potentially a low value company. However, the reason they had negative free cash flow was because they were building new stores and a growing business. So that's actually a good thing. That's indicating they've got potential to grow their operations and their profitability in the long run. However, the issue is we need to get our forecasting timeline right. So if we were valuing Walmart in 92 and we were doing like say 4 or 5 years of free cash flow forecasts, we might still be forecasting negative free cash flows. So our overall valuation would be very low. The disadvantage of the free cash flow model that I'm trying to illustrate here, for some young growing companies, they may have negative free cash flows for quite a long time. And that means our forecast horizon will have to be very long, which is difficult. If I'm trying to predict 1 year in the future, I might have an okay accuracy. But if I'm trying to predict something 10 or 20 years into the future, my accuracy is going to be much less. So the free cash flow model, because it's not using our business's assets on the balance sheet, we're just looking at the free cash flows, we have to have a much longer time horizon for our forecasting, which can increase. So to further illustrate that point, for US listed firms from 1960 to 1996, so a bit of old data, but this trend's probably getting even worse now with the tech firms becoming very popular. We've got deciles, which just means all the companies listed in these markets are grouped into groups of 10%, so the top 10% and the bottom 10%. Firms in the bottom 10% had really significantly negative free cash flow and no dividends. Firms in the top 10% had high free cash flows and high dividends. And then as we go through here, well, about 40% of firms have negative free cash flows, and about 30% of firms here don't pay dividends. So if you were trying to value a company using the free cash flow model or the dividend discount model, then 40 or 30% of firms, it's going to be really difficult because yes, the models can work, but the difficulty is you'll have to forecast many, many, many years into the future. You might have to forecast Walmart's performance for 10 or 15 years from 1990 before they start regularly making positive free cash flow. Okay, so that becomes difficult to actually apply in practice. So what are the advantages and disadvantages of the free cash flow model? Well, it's an easy concept because we can think about free cash flow as being real. Free cash flow is the cash flow that goes to either equity holders or debt holders. It's not manipulated by accounting adjustments very easily because cash flow statements are much harder to manipulate relative to an income statement or balance sheet, which has accounting choice. So we don't have to be as strict with our accounting analysis when doing a free cash flow. And it's a straight application of our normal net present value techniques like a dividend discount model or valuing a bond. So the formula itself is pretty straightforward. But the disadvantages, free cash flow doesn't necessarily measure value added in the short run. Okay? What do I mean by that? In 1993, when Walmart had a negative $2 billion free cash flow, they were actually generating value. They were building new stores that eventually would be profitable. The free cash flow shows a negative. It shows they're destroying value. But in the short run, they destroyed value by spending money, but it was actually in building assets. So the discounted cash flow model doesn't capture those assets that are purchased. Okay, you have to have very good forecast. So that's why it's not capturing value in the short run. Okay, investment, such as building those new stores, was treated as a loss of value as a negative cash flow. Free cash flow is a liquidation concept. Firms can increase their value using this model if they cut back on investments. But we know that cutting back on investments is not a good long-term strategy. So again, it's a little bit of a problem with this model. So to solve those issues that we just mentioned, we'd have to have really long forecasts. And the longer your forecast, the more likely it's going to be inaccurate because the more years we're trying to forecast, the more things could go wrong. And people generally aren't forecasting the free cash flows, they're forecasting earnings. So it makes it a little bit more difficult when analysts are following the business and talking about their earnings per share estimates. If we then want to try and turn that into cash flows, there's an extra step of difficulty there. So when does this model work best? Why is it so popular? Well, it works best for mature companies, these firms in the top couple of deciles of free cash flow, mature, stable companies that are able to generate cash from their operations. This model will work well. Okay, so it does work well for some companies, but there are some disadvantages. There are some cases where it's hard to implement that we need to be aware of. Check out the demonstration video on how to apply the discounted cash flow model, and I hope that's helpful for you. Thank you very much.